think of it in the positive round. Like you want to give them the options and say, hey, I could do it like this, or we can do it like this, or you could do it 1031 yourself. Would you do it for lower if we could structure that? And so now you're more than just a buyer, you're an advocate on their side as a seller.
With me today at the Conscious Investor podcast. Brett, welcome to the show.
Julie, great to be here. Thanks for having me.
We're all curious. I'm especially curious because I know what you do, but I don't know enough about what you do. So what do you do, Brett? And how in the world did you get started?
Yes. So most high net worth individuals, they struggle with capital gains tax when they go to sell these multi-million-dollar assets. It could be business, crypto, real estate. And that tax is somewhere between 25 and 50% of their proceeds is going to be crushed. The government is your biggest partner, our biggest partner, if we don't know that already. And so we use a unique strategy in particular here at Capital Gains Tax Solutions to help people defer that capital gains tax, unlock freedom, we call them the 10 freedoms. And the strategy is called a deferred sales trust to give people an ideal exit, right? Versus having to be taxed, heavily or not exit because they're feeling trapped by capital gains tax. How I got started starts with the story of growing up in an entrepreneurial real estate family in the Bay Area of California, building houses. Yeah, building houses. And so this is Silicon Valley days, Fremont, Mission, San Jose, East Bay. And my parents, we'd build houses. I loved it. And back then, I've just turned 40. Business was different back then. You could actually, it was kind of friendly state to do business. And you can imagine that California being friendly about that. But I saw firsthand how to build wealth and how to be an entrepreneur. But then I also saw the changing of the guard, if you will, with taxation and regulation and just the constraints it brings on businesses and families. And so my parents were actually divorced at a younger age in between all of this. And then I also saw wealth, how it separates families. And so at a early age, I guess, inherently knew that I wanted to be very successful to make, good money so that money would never come between myself and my family. Married now 14 years, 5 kids, and it's been a dream of ours to be able to be flexible with our capital, but also help others do the same thing. And so fast forward, I also was at a place called Marcus and Millichap, helping people buy and sell multifamily properties. And then so they got decimated. A lot of people got decimated in the 2008 crash. And so we actually realized that the 1031 exchange can be an enemy, right? And so we have a saying around here that friends don't let friends, overpay for a property in 1031. Well, that's what happened a lot, and people got caught with too much, tax and too much debt, and ended up losing a lot of wealth that otherwise us as real estate, individuals and investors would, wanted a different way out. And so that's when we basically started to be on this mission. And so, fast forward all these years later, we're here to help people understand what their challenges are with tax when they exit, and then have great solutions to get them the freedoms they desire.
I love this. I love all of this. And you know that, but Conscious Investor, these are real situations, and you don't have to be living in, transacting in, or from California to be facing all the implications of the liabilities that taxes bring into our investing. And if we don't have a strong strategy as to how we are navigating that element, we lose so much money. And I don't want anybody losing, which is why Brett's here. Brett, I'm curious. You said we can get caught with too much tax and too much debt. Can you go a little deeper into that?
Yeah, I want everyone to think about 3 things right now, right? Most people think about cash flow, which is kind of inside, if you're watching this on YouTube, inside this box. And, I'm making 6, 7, 8, 9% cash on cash. My IRR is at, 12 to 15% over this, 3 to 5 year time horizon. That's cash flow, which is important. But there's also tax flow. That's on the outside of this box. If you open that up, that's before you show up and after you exit. And then one that we've taken for granted these last few years is debt flow, right? And most people say cash is king. It's all about cash flow, cash flow, cash flow. Well, we're here to tell you, yes, it's definitely about cash flow, But it's also equally important about tax flow and debt flow. And now what we're seeing is the negative arbitrage situation where we used to be able to borrow interest rates at about 3.5% and have a cap rate maybe of 5. Well, now we're at 6, 7, 8% on the interest rate and a cap rate maybe about 5, maybe 6, depending on where you're looking at and where things are going.
Mhm.
So it's this negative arbitrage. And so now people are going, I don't know what to do. Should I sell? Should I not buy? What should I do? Where am I at? So understanding those three dynamics is really important. And now the one thing that keeps these all things connected is time. In fact, we believe that time is the single greatest factor when investing, right? Time horizon, right? Associated with your risk, and also just the time that you're trying to unlock for yourself or for your family. And so when you're looking at this kind of in a three-dimensional way versus just like a static, oh, I put in $1 million and I get, 70,000 a year of cash flow. Well, it changes the game. And when it does, or if you don't know about this, it's like, the battle you don't know you're fighting is the one you're going to lose, because when interest rates jump so high and a lot of these deals that had cap rates that were, or interest rates that were capped are now expiring. And now a great deal, a really good deal has gone bad because the debt has poisoned the deal in a sense, right? So you've got to know how to exit and make time your friend and
Mhm.
debt your friend when it makes sense with cash flow and tax flow. Yes, it is a bit complex. This is why we get paid to do what we do. But if you're not having professionals help you execute these plans, you're going to be stuck in the one-dimensional game.
Okay, what's the cost? Okay, two questions, and let me ask them in a very singular way. And the first question is, you and I are familiar with arbitrage. It's something that we engage with and interact with all the time, and people throw that around. I remember entering into the investment space and hearing people talk about arbitrage and feeling a bit lost. I don't know that I have found a really eloquent way of describing arbitrage to people. You have a great way of describing things. Can you explain arbitrage so that the conscious investor is like, I get this?
Yeah, it's like the positive or negative margin between basically the interest that you're borrowing at and the cash on cash return that you're receiving, right? Or the cap rate. And you could do arbitrages between anything. You can go to the grocery store and say, hey, I bought a 5 gallon of milk, but my interest rate on my credit card was 8%. Well, that's a negative arbitrage, right? Because you're having to borrow at, and that really didn't work for milk because milk is like just a singular price. But if the price of milk was going up and down and you're having to borrow at that, that's really the difference.
Eggs. Let's go with eggs.
Yeah, eggs can go up and down too. So yeah, so in this scenario, for your cap rate, which is we can break that down, right? It's your unleveraged rate of return. Your cap rate is your unleveraged rate of return, which means it's your cash on cash return is if you bought something all cash. And so if you're buying a property for $5 million at a 5% cap rate, if you bought it all cash, you would have a 5% cash on cash return and you'd have a 5% cap rate. It's your unleveraged rate of return. And so in the past, when we could have positive arbitrage or positive leverage, that meant we could borrow at a lower rate, put a lower down payment on, and still have an extra arbitrage between the two. So that's a good thing. The bad thing is when you're having to borrow at a higher rate and your unleveraged rate of return is lower, and therefore you're kind of going backwards.
Thank you. Great. I appreciate that. And I think it's always good to have, experts like you explain these concepts because we all explain them in our own way. And it's really powerful to have that. So people are paying too much in taxes, too much in debt, and they're not leveraging time. Can we go through a scenario? Because let's be real, we have people that want to transact, and ultimately, maybe it's better that they transact in a different way. So, can we actually walk through a scenario with some simple numbers to show people in real time how this actually plays out just in an average investor's life?
Yeah, exactly. I want to use live actual deals, okay? Because I think this is even more powerful, right?
Right.
And so we had two clients. They bought cryptocurrency, okay, and then one of them bought it for about $50,000 of Bitcoin, and it went to 50 million. In fact, this is a client of mine. She worked for Google. She's very, very smart, and she said, "Wow, I have this huge gain." She never sold a Bitcoin, and I don't want to pay a huge tax. And so she met us, and before the crypto crash, if you will, about a couple of years ago now, a year and a half ago,
Right.
she sold with us 5 million of that Bitcoin into the trust, diversified that wealth, okay, and then started a company with her one of her college roommates. It's like her dream. So the freedom for her was the ability to not have to work for Google anymore, and put into her work. And it's an educational, like online Khan Academy type of program for
Oh,
kids.
cool.
So that was her vision, right? So she exited the crypto tax deferred and used the capital to unlock that thing. So the first thing to understand for people is you got to clarify the vision for whatever the things you're trying to do. So when you're
Okay.
investing, what is it about what you're going to invest in that's going to achieve for you the outcome that you want to achieve? It's called the A to B exercise. And so that's the first one. And so she achieved that with the trust, is that kind of that bridge between the tax of about $1.85 million of tax. Instead of paying that, all 5 million went into the trust and essentially funded her business dream. That was great. Now, what happened to Bitcoin? It went up to actually to 68,000 a coin. We exited at 54,000 a coin. Then it dropped to like, 15,000, 20,000 a coin. Now it's on its way back up again. Okay. So that's a practical matter that the trust helped her to sell high and diversify. Number two, we did a multifamily. I'm sorry. Well, we did that one too, but we did a car wash sale in San Diego. This is a $13.5 million sale for 4 partners. They bought this land for 500,000. They increased the value to about 4 million all in to build the car wash, and they sold it for about 13 and a half. Right. So that's a huge gain. Now in California, the tax is about 40% of that gain. And so they also were looking around saying this marketplace is not making a lot of sense. We did this deal about 2 years ago now too. And they said, we don't want to overpay, and we actually want to develop land and buy. What's going to give us that flexibility and the time to do that? Well, also paying off debt. And so this is where tax flow, cash flow, and debt flow came into thing, because they got out of debt, they deferred their tax, and they got their cash flow timing on their side. We invested into a lending fund that was paying 10%. That's never lost a single dollar. And now we're waiting for this market to drop, which is doing it right now. We're seeing the values finally come down, which is when we're going to pounce on the deals and make all of this our friend, right? And so hopefully that makes some sense. Any questions on that, Julie?
I love this. Can I break it to, can we have one more scenario where we break it down, and let's just say that uh owner operator, they own a 10plex. It's, in the Midwest. We'll put it in the Midwest because nothing in California is going to be valued at $1 million, but $1 million is easy to wrap our heads around, right? So owner operator, they own this this complex 10 multifamily unit. It's worth $1 million. They're selling it. Now they're like, oh, let me go 1031 this. It's like, no, let's not 1031 this. What's the difference actually play out to be if they were to 1031 that asset versus if they were to go into a deferred trust?
Yeah, so a 1031 exchange is a continuity plan, meaning that you're just rolling your funds into the next deal, right? And you're trading up for the next property, and you continue to roll that. And you do that within the 45-day window to identify, 180 days to close. We do have the best 1031 exit plan, which also gives you a backup in case that fails. And so, and by all means, we love 1031 exchanges when the tax flow, debt flow, and cash flow matches up for what you're trying to achieve. So start with the vision, start what you're trying to achieve. And when those line up, and sometimes the stars align, right? Now, we're not seeing that really right now because a lot of sellers are not willing to accept these lower prices, partly because as soon as they sell, now they're in a negative arbitrage position and they're chasing themselves to try to find a deal, or they're going to get hit with the tax consequences, right? So it's become a lot of stagnation, right? That we've seen for most, that's why transactions are down so much, because the tax flow, cash flow, and debt flow is mismatched. Okay, but hypothetically, you can sell that $1 million property. Let's just keep it free and clear. And let's just say your basis was zero. You fully depreciated that 10plex over 27 and a half years. So you're going to pay somewhere around $300,000 of tax liability. So you've clarified you had a big tax problem, and now you sell it. We move it to the qualified intermediary. You work with us to do that. And then you find a deal. Great. You found the deal. You can move into that. You're happy. Or you say, you know what? I'm not finding the deal I want. Actually, I don't even want to be that active per se, at least right now. And I'd like to just put the rest of it into the trust, or all of it into the trust. And sometimes we're doing partial 1031s and partial deferred sales trust. But in this scenario, let's just say you went all the way into the trust. Now the money is sitting typically like a Charles Schwab. We're going to go immediately into T-bills, making 5%. But then we're going to start to diversify and look at different places. We might say, hey, Julie, what do you have going on? She goes, hey, I got a sweet deal. I actually need about 250,000 to raise on that. Great. Let's put 250 over there. Then you might say, look, I found a perfect $750,000 deal the next day or 6 months from now or whenever, we can set up an LLC. The trust can go into that one. In other words, time becomes your friend again, but you can also diversify. You could put into a lending fund. You can put a mobile home park. You can put into multifamily. It's kind of like an IRA. If you think about it, what's an IRA do? On an IRA, you put the capital into the IRA, you defer the income tax, you defer the capital gains tax, and then you can diversify it into basically just about anything, right? With no timing
Right.
restrictions. And so we're kind of like a 1031 IRA. We're kind of like an IRA, kind of like a couple different things, but that's the basic model of it, if that makes some sense, Julie.
No, that totally makes some sense. So when we look at, and this is all hypothetical naturally, but when we're looking at the, what we're actually walking away with in our pocket, if we choose to ignore all of these options of going 1031, of going deferred, trust, if we ignore that, the implications tax wise, I know you and I've spoken in the past and multiple times. And what stood out to me, and I'm having a hard time communicating with people, is listen, ultimately, this $1 million, you're going to be walking away with 3/4 of it. Maybe you're going to be paying, 350,000 in taxes. There's a better way. How do we keep this 350? So that's what I'm really curious about. Like, how does this actually break down into, okay, listen, if you're just going to go the standard route, I sold, signed on the dotted line, I'm paying the taxes, you're really only going to net about X. Let's go these other routes and let's keep the money in your possession.
Yeah, I think let me give a real life scenario. This is Warren and Catherine Strand. They had a duplex that they sold in Manhattan Beach, and they bought 15 units in Sacramento, California. I'm also a multifamily broker, so I sat down with them and said, "Look, if you do a 1031, here's your scenario, or if you do deferred sales trust, or if you just hold where you're at." And they're more leaning on just holding where they were at because the property was cash flowing well. They really had no debt on the property, and their NOI was about $120,000. But it was taking up their precious time, a little more than they wanted to. In fact, they had two twin daughters later in life, and they really wanted to spend time with them rather than the toilets, trash, and termites that they were they were kind of wasting their life away on that. And they had made the millions of dollars, are ready to move on. Anyway, so we did the analysis, and we basically said, look, we can get you about $190,000 of cash flow from the trust. You have no toilets, no trash, no termites. You have no more time and energy spent on the property, and you're diversified. They said, how can we sign up? How fast can we get this thing going? And we went through 3 escrows, persevered through 3 buyers, almost backing out, and finally made a deal. And they are thrilled about it, right? And so first thing is looking at ROE. You want to know what your total value of the asset is that you're about to sell, right? Minus the closing cost. And you're gonna look at your current cash flow, and you're gonna take one divided by the other, and that's going to give you an ROE. In this scenario, I think their ROE was around like 3 to 4%. And we're basically almost like increase the cash on cash by about 60%. And so they start to check off the right side of the box. I get to defer my tax. I get to increase my cash flow. I get to increase my time, freedom. And they're like, this is a no-brainer. And what actually happened is the trust receives the capital and owes them back the money. And so it's a lendership is what we call it, right? Where you can be a
Right.
lender from an owner, you're moving to a lender, and the trust owes them back the money slowly over time. And that's the beauty. That's why we don't have to do a 1031. That's why it's not a 1031, because it's a seller carryback with the trust, which is different for people. And that's really sometimes the biggest thing. It's
Right.
like they've been doing the same thing for so long. Now they're doing
Right.
something a little bit different. And that's the shift that we help people understand how to do all this.
Okay. I absolutely love this. Now, conscious investor, I'm going to ask a very self-serving question here because you got me thinking. I was literally in Santa Monica a couple of weeks ago, and the Uber driver, as I'm driving back to the airport with one of my best friends, he's, turns out this older gentleman, he bought right. He bought blocks from the beach in Long Beach. He has his house over here, but he wants to move back to his homeland. He's like, yeah, I don't know. It worked out. I only paid like $650 for, these 5 units in Long Beach, walking distance to the beach and everything. And so it got me thinking, it's like, how can I explain to him, like, man, there's another way around this, and it could be so easy. I did tell him, I'm like, I would be happy. Like, here's my card. Let's talk. I'd love to purchase these. Obviously, you want to protect I mean, the ultimate thing, and this is why you're on the show, because I know that you're into finding like, hey, how do we have this win for everybody? Everybody should be feeling like they're getting the very best deal and that this is serving their goals, their A to B in the most powerful way. How do we approach, how do you educate people in the sense of, hey, amazing, seller or conscious investor, you might be listening and maybe you have that second home, by the beach or in Tahoe or, up in Vail. And you might have your place that you're like, dang it, I don't have to manage this. How can they become the seller carry in this situation? How could this work in that capacity? And you touched on it already, but I'd like to go in more depth on that.
Yeah. So first we talked about vision, right? So envisioning your
Yeah.
future, ideal future. So we talked about that, and then it's really figuring out what strategy or strategies is going to help you to get to that ideal future, and then it's about building the team to help you execute this, right? Because we can spend all of our time trying to understand all of the reasons how I had ACL surgery on my knee. I played basketball in college, and I blew my knee out, and then I got the ACL surgery, and I went in there. I was like, "Hey, doctor, like, how many of these have you done?" He goes, "Thousands." I go, "Okay, cool. Who did you work on?" He goes, Chris Webber. And this is like a Hall of Fame. I'm like, okay, if you worked on Chris's knee, you can work on my knee, right? Great. And so we absolutely educate people on how everything works. But at the end of the day, you got to trust the process and trust the people to execute the strategy to get you to where you want to go. And so the neat part of the deferred sales trust is thousands of closes, billions and billions and billions, assets closed over 27 years and over 24 no change IRS audits, batting 1,000, absolutely perfect, right? So once people understand that it's legal and it works, even though their CPA may not know how it works or know that it's legal, they don't know. They're a family practitioner who does general, blood work once a year and, takes your temperature and maybe gives you a flu shot, right? That's nothing wrong with that. They're a general practitioner. But when you need ACL surgery or you need a hip replacement or knee replacement, you're going to go to a specialist. And so we're experts and Navy SEALs at this. This is one big moment in time. So you hire us as the team to execute this. So once you get comfortable with the legality, and by the way, bring the CPA in and have them ask the questions. We'd like that. In fact, they all join us and send us their clients. This is what we found.
Yeah.
Then the second thing is the controls and the protection of the cash, right? The ability to know that you are the secured lender. Nothing without your approval or your signature, that you can invest into whatever you want. You can work with financial advisors. If you want to diversify into the stock market, you can absolutely do that. You can go into your own real estate deals. We have entrepreneurial clients that are selling and building assets of their own, right? With no 1031. You can, it kind of like checkbook control. So just understanding that you can't really put the DST in a box. It's really about executing the plan. The last one is like, well, fees, it must cost, arm and a leg. It's not inexpensive, but you got to understand how to make the DST an investment, not an expense. But if you spend 5 hours with us and talk with our clients about this, we found that it becomes transformational for people. And they go from transaction, planning to transformation planning for their family and their legacy. So hopefully that answers the question. We can get more technical if you'd like, but that's kind of the answer I would say. And we have our YouTube channel and our book to give you all the education you could probably consume in a given day.
Conscious investor, I want to encourage you to definitely head over to the YouTube channel because there's so much. Brett goes into so much depth, and this is probably your first pass at hearing this type of information, or you've heard people say that talk about deferred trust, but you don't really understand it. And so this is something I want to encourage you to continue to educate yourself on. YouTube channel. I always talk about there are free ways to educate, and then there are the baby step, and then there's the major step, right? And so baby step is go buy the book, Building Capital Gains Tax Exit Plan. And then you can actually go and work with Brett, right? And so you don't have to jump in right away. You can always just go do the free education, but nothing is more effective than actually committing and putting, your money and investing into, okay, this is a path that I am going down. That's why we join masterminds. That's why we go to events and we invest in ourselves. But I am going to circle back to the question, and I'm going to say, okay, what if somebody does want to do, have a seller carry and they're like, no, I really like this. I want to help this person out. I want to help them in buying this. And I can see that I don't care. I can still get the cash flow off of this. This will work for me, but I don't know how to go about this and navigate that process in a way that's more tax efficient.
Yeah. So it sounds like, why not just do a traditional blockbuster installment sale with the buyer? Is that what you're asking, Julie?
Yeah, I think so.
Okay. Yeah, I think so too. And by the way, installment sales have been around since the 1920s, right? And that's our foundation of our structure. And so a traditional blockbuster installment sale is typically very great for the buyer, right? It's really great for the buyer because there's no banks involved. If you're doing, if it's 100% financed by the seller, there's no appraisals. It's typically lower interest rates than the banks. And the main reason, though, that people are doing these is because they don't want to do a 1031, and yet they want to sell and not incur the tax all at once. The
Mhm.
challenge is they're typically short in nature, somewhere between 2 to 3, 5 years. There's no prepayment
Okay.
penalty typically. And typically there's a refinance event and they just pay their tax anyways. And so they got this little short
Yes.
snippet of it, and which is great for them for that short snippet. The difference with the deferred sales trust, why we think it's Netflix, is because you can go on for 10, 20, 30, 40, 50 years. You can pass it to kids. The interest rate is typically somewhere between 6 and 9% compounding, right? You can get a new depreciation schedule. The funds can be liquid. It can be diversified. You're not subject to that one asset, because guess what the worst nightmare is? It's selling Julie that property and Julie not performing. Now, Julie's of course going to perform. Let's just say it's someone else. Let's say it's Susan. Susan's not going to perform. And then they have to foreclose on it 3 years later, just when they're getting comfortable without having to have it. And then
Yes.
they're like, gosh, now I got to take back the tenants, the toilets, the trash. That's a nightmare, right? So in
Right.
our scenario, we're completely separating the asset that they sold,
Yep.
right, from the cash flow, tax flow, and debt flow strategy. And we're allowing them to have those freedoms. And so you can choose to do blockbuster installment sales, but most people want the Netflix, right? So hopefully that's a fair answer,
Exactly.
Julie.
Well, and I really appreciate that because, oftentimes, and I'm prone to this as well, but I am always seeking, this is why we're having this specific conversation is, hey, I love seller carry. Let's bring on seller carry all day long. That serves me as a buyer in a super profound way. I'm getting great terms, and I could even be giving you a premium price as a seller. Like when we're negotiating in the world of terms, like we can create some great terms, but to your point, most buyers are going to refinance within 3 to 5 years. And so now this is where it's no longer favorable. And this is where my heart is at. I'm like, well, it's a win for the first period of time, but now I'm going to go back and say, hey, seller, I refied and here's your chunk. And now, now you've got a nightmare on your hands and you're paying a bunch of taxes, which is the whole reason you were trying to not do this. So so I love that you were raising awareness to that, is how is
And
this
let
actually
let
really.
me add to that too, right? So you're exactly right. So our instinct is to say, okay, if you're going to do a seller carryback, I'll increase the price. Now I want you to think about the DST. It's the same seller carryback, except it's with the trust. But when you open up all of the value, right, then
Mhm.
you perhaps can lower the price. And so let's just do a scenario. Let's say you're going to buy a $5 million apartment complex and it's worth 5 on a fair market value, but you say, would you carry back and I'll pay 5.5? And on
Mhm.
a traditional installment sale, they're like, yeah, and I'll give you that no interest for the first year and a half. And then it's 3%, 4%. It's like an amazing deal. Boom, 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 right? Great. But you overpaid by 500K. What if you
Mhm.
reverse that and said, what if there's a way to show you a way to defer the tax? You're still going to do a seller carryback, but it's going to be with a trust. But it gives you all these amazing freedoms, like, offer stacking. Here's the value, time, diversification, liquidity, the ability to do your own deals if you want to, the ability to not have to do your own deals if you don't want to, all of this stuff, eliminate the estate tax, like, all these things. How about I pay you 4.5? How about I pay you, I say 500,000. Now on your side, you've just used that to your advantage because everyone else is offering them a traditional installment sale, right? Or telling them to
Mhm.
do a 1031, but you really solved the freedoms they desired, right? And so now you can negotiate a lower price. So we've seen that happen, right? So think of it in the positive round. Like you want to give them the options and say, hey, I could do it like this, or we can do it like this, or you could do it 1031 yourself. If you do a
Mhm.
regular installment sale, here it is. But what if we did a DST? Would you do it for lower if we could structure that? And so now you're more than just a buyer. You're an advocate on their side as a seller, right?
Mhm.
And if you're an agent listening to this, You're more than just a transaction agent who is just looking for that 1031 and getting that paycheck. You're now an advocate for the seller to unlock the freedoms that they desire, right? Not just the paycheck. And I struggled with that in the past. At Marcus and Millichap, it was all about just like transactions, 1031, 1031. We've sold over $500 million in commercial real estate transactions and DST transactions. So I get that. That's how you get paid. But you can't unsee the DST once you see it.
Right.
Once you see it and you know that it's legal, it works, it's never not worked, and it can unlock these freedoms, it's like we owe it to our clients, to our investors to share the information and let them decide what they want to do.
Yes. Oh, I love that so much. I appreciate that. This is just such powerful information, Brett, and I appreciate the way you're able to just explain it in a way that is accessible. And conscious investor, I know Brett and I both talk fast. I think you speak at a faster cadence than I do, which is amazing. So feel free, go back, listen to this again. You can slow down the speed on your podcast if you want to, but make sure that you are heading over. Brett has a powerful podcast, and we'll drop a link in the show notes. So you want to go listen to this. The more familiar you become with the terminology, the easier it is going to be to really understand and wrap your head around all of this concept. Because honestly, you and I have spoken multiple times, and it has taken me multiple conversations for me to really kind of have that paradigm shift. Because I mean, yeah, like you, I was raised in real estate in 1031, 1031, 1031. And so, yes, there are times, as you've said, there are appropriate times to use 1031 if it's in the, your box and everything. But here's this other avenue. And I feel like we're just scratching the surface in the, of raising awareness and saying, this is something.
And let me do a little awareness on that too, right?
Yeah.
So the 1031 only works for investment real estate. And there's a stat out there that 50% of the total net worth in America is tied to commercial real estate, primary homes, and private equity. Okay. Private equity is like businesses. Well, 2/3 of those assets are not tied to investment real estate, right? And so if you're raising capital, if you're trying to do deals, trying to unlock capital, the 1031 doesn't even work for that, right? So the deferred sales trust works for any asset of any kind. And so you can defer that tax. You can go right into a real estate fund. You can go right into your own deal. You can go right into starting a business. You can go right into the stock market. You want to diversify a little bit. Depends on wherever you want to go into cryptocurrency. We just did our first NFT deal last week, Julie, for a client, and the crypto market's starting to roar back. And so we think 2024 is going to be a massive opportunity. But imagine this, okay? Imagine you or someone who's listening to this has Bitcoin, Ethereum, an NFT or something that's worth $10 million that a year ago was worth, $1 million, right? So now it's this huge gain that you can push a button and it goes into the deferred sales trust. And then you can push a button and it goes to a cash account, a bank account in the name of the trust. Then you can push a button and it can go back into your own real estate deal or go into one of Julie's deals. And those are just a few button pushes without having to incur all of that tax liability all at once, right? That's the power of the deferred sales trust. We think it was created for times like this, and it's the single best way to unlock capital and to bring capital to causes like the housing crisis, right? There's there's an estimated $84 trillion that's passing from mostly the baby boomers in the next 20 years. There's over 10,000 baby boomers turning 65 every day. And there's over 77 million in the US alone. So this is the largest wealth transfer in the history of the planet's happening. And if you don't have a great deferred sales trust or other taxable strategy ready to go, deals aren't going to happen, or people are going to get crushed with tax. And so that is the importance of where we're at right now. We call it the reverse Tea Party. It's happening right now. The battle for the wealth of America in the hands of the government or in the hands of the people. After 240 years, in the beginning, we fought for representation, right? And now 240 years later, we built more wealth perhaps than any country ever. And now it's about to transfer to the next generation. And it's during that transfer that's the most vulnerable for tax. And that's where we plug right in and we can help with this $84 trillion transfer. And imagine just taking a third of that $84 trillion, deferring that tax and infusing it into multifamily housing communities, right? infusing it into mobile home park communities, infusing it, and that would solve the housing crisis, right? But if that tax strategy is not solved for, guess who grabs it? Uncle
Oh,
Sam. And what's Uncle Sam going to do with it, Julie?
start another program and add more bureaucracy. Sorry. More red tape. Sorry.
Yeah, a lot of waste, unfortunately. They, whether it's whatever side you vote for, a lot of waste, but that's how our mission is to make a difference, make an impact, not just, with return on investment, but return on impact is really important. And so, yeah, that's, yeah, check out the book, Building a Capital Gains Tax Exit Plan. Check out the YouTube channel. Check out the Best 1031 Plan. Those are all the places to check it all out.
I love it. I have one question. We're going to wrap up here. And this is not my favorite question to ask. And I don't honestly ask this all often, but I think it's a fair question because you're going to have a lot of listeners are going to be skeptical. They're going to be like, yeah, I've heard, because in conversation with people, when I've mentioned this, they're like, oh, that's that thing. And so I'm sure you have faced the resistance. And so I'm curious, what are some of the wrong beliefs or assumptions that people are making about deferred sales trusts?
Yeah, absolutely. And so, by the way, whenever we have beliefs around anything, right? There's a study or there's just science, right? You have to tell a better story, right? So you have the logical reasons, right? So I'm going to tell a couple better stories to help people with that. But there's really three false beliefs with the deferred sales trust, right?
Okay.
It seems, here's number one. It's too good to be true. I have the best CPAs and legal team, and I'm an expert in 1031 exchanges and real estate and
Yeah.
I've got 50 million, $100 million, and I've got the best of the best. Like they would already have known about it. What happens sometimes is they bring it to their people, and this is like the most kind of a rookie mistake. They say, "Hey, have you heard of the DSTs?" And they go, "Oh yeah, I've heard of DSTs." And they go, "The Delaware Statutory Trust," and they go, yeah, I've heard of those, right? And they go, no, we're not talking about that. We're talking about the deferred sales trust. So the first thing is make sure when you're bringing it, you're actually saying the right word. And the person on the other side is looking at both DSTs and understanding that they're very different, okay? So what's the better story for that? Well, there's a gentleman named David Young. And David Young ran with a guy named Bill Gross. And you might say, well, I don't know who these guys are. They're kind of like a Mark Cuban. They're kind of, they're kind of like I don't know, like a really fancy, smart people in that industry, whatever industry you're in, right? Like Mark Cuban's one of the most biggest entrepreneurs in America, right? Well, Bill Gross and David Young are that for the financial advising industry, right? And they managed and built a company with five guys called PIMCO. Now, you might have heard PIMCO before, but they're one of the largest bond money managers in the world, okay? Well, about 20 years ago, these guys built PIMCO from 80 billion to 1.2 trillion. So massively grew the company. They're wildly successful. They manage some of the biggest wealth in the entire world, okay? So they're very smart. And if you can imagine, Julie, people want to get to the very smart people to sell them their tax strategy, to unlock their client list to them, right? Pretty simple. So David and Bill and five guys, they all retire from PIMCO, and David and the five guys form a group called Anfield Capital, okay? And about 6 years ago, they get approached with the deferred sales trust. And David's first thought was, oh no, here we go again. Another offshore thing, another like new idea, another thing that's not going to hold mustard that I don't want to be, put a 12-foot pole and touch it. Like, and just stay away from it. It's just, but we said, look, it's different, David. It's different. Would you take a closer look? He goes, okay, I'll take a closer look. And for 2 years, he took a closer look, 2 years. Okay. Not 2 weeks, not 2 days. They signed the NDAs. They did what every, really good professional does. They do extensive due diligence. For 2 years, they fly back. They meet with my business partner in the Midwest, and who sits down on the whiteboard and goes through the entire strategy with their entire legal team. And they came through with two conclusions. This is like a 2-day retreat. Number one, that gentleman is the smartest guy they've ever met. It's my business partner. Number two, we're all in on the DST, right? And they're on an inner circle, and they can manage capital for any client or anyone who's listening out there that's a part, that's working with us, okay? So that gives me a lot of confidence, right? Because Julie, guess what? If it's good enough for David Young and his legal team, after 2 years of due diligence, some of the best in the world for 30 years, managing some of the biggest capital in the entire world, is it good enough for me, Julie, and whoever's listening, and the CPA who's a skeptic?
Right. Oh, right. Exactly. I'm definitely not as smart as those guys, right? I mean,
am I? Right? I just know that I know them, and they went through the process,
yeah,
right?
yeah.
And that's the beauty of this. you can have confidence that third-party validation, third-party groups, we have former IRS agents that are tax attorneys that have been through this, national law firms. We have lifetime audit defense built into every single trust. Number two, we only charge if and when you close the deal. So there's literally no obligation to do the DST. It's 100%. You can do the due diligence. So you have nothing to lose to come and talk with us. So that's number one. That's the legal part. I know that's kind of long, but I think that's like the biggest domino to knock over.
Yeah.
Number two becomes control, right? So we think in our minds that as real estate investors that we have all of this control. Like we have all the control. We're the entrepreneur. We're running the show. Well, guess what? If you have a loan from a bank, guess what? You've given up some control, right? And they have certain guidelines you have to follow. And if you don't do certain things, they're going to foreclose and take all of it from you, right? Number two, if you use a 1031 exchange qualified intermediary, you're giving up some control for a period of time, right? And you have to work within those guidelines. Same thing with IRAs and 401ks. So we actually are moving in and out of different controls all the time. Well, it's a false belief to think that the deferred sales trust is any different than these other controls. It is a little bit different in the sense that there's a third-party unrelated trustee, and that's our company, right? And you don't have unilateral control as an owner of an asset. You are now the lender, so you're becoming the bank. But there's arguments, once you understand it, that show that as a lender, you have more rights and protections as a bank, as a lender, than you do as an owner. But most people aren't used to that, so they have to get used to that. And so what does that look like? Well, you work with a third-party trustee. That's me. We don't invest funds until you approve it. We also have to approve it, but we have to work within the guardrails of the deferred sales trust, which also leads into the next thing. People think that might be capped on the interest rate. They go, Brett, I don't want to be capped at 6 to 9%, right? I want to be able to make 15 and 20%. Are you saying that I can only get return on that money? No, we do a joint venture partner with the trust, and you get 80 to 98% of the upside the way that we structure it. So even if you put 10 million into the trust, at 9%, let's say that's a 900,000 per year, you might go make 20% on a deal. And the way we structure it, we can get you the majority of that upside. So you're not capped. So that's another false belief. And the last one is it's just too expensive. Fees are too high. And we teach you how to make the DST an investment and not an expense. And that is first through timing, right? Hopefully you sell high and you buy low, right? We talked about that before. Hopefully you diversified, right? But you also get a new depreciation schedule the way that we structure it. Hopefully we can also eliminate your estate tax if you have estate tax challenges. Okay. And oftentimes though, we're increasing the cash on cash return by 30, 40, 50%, the way that we're investing the funds rather than just staying on the return on equity part of it. So these are all ways to make the DST an investment on expense. So we can keep peeling back this onion, but once you overcoat these three, the legality, the control, and the fees, we find that the big domino falls and everybody says yes to the DST.
That's amazing. And I knew I had a feeling you faced this. You faced the resistance and the skepticism over the years. So thank you. I appreciate that so much. Brett, I thank you so much for taking time to serve the conscious investor today and to just raise awareness as to there are options out there. And I'm in full agreement that the money in the hands of the people is so powerful. And there are plenty of studies and research that demonstrate how when the money is kept in, private party hands versus in the government hands, there is so much, a far greater impact in the world. So I'm all about that and all about the impact element. All right. Once again, let's tell the conscious investor exactly where they can find you and connect up with you.
All right. So 3 places. Number 1, go to capitalgainstaxsolutions.com. That's all things deferred sales trust. Number 2, go to brettswarts.com. This is like our funnel hub where everything lands, and you can get access to experttaxseekers.com, access to our book, access to our YouTube channel, all of our social media. So if you want the catch-all, just go to brettswarts.com. I'll spell that for you. BRETT, and it's SWARTS.com. Okay. If you do go there, that have everything that you could imagine to learn more about everything that we do.
I appreciate it so much. Thank you again. And conscious investor, don't let this type of information just pass you by. You will likely know someone who is going to benefit substantially by being exposed to this type of information. So oftentimes I will ask you, will you please, go leave an honest rating and review for the show? And while yes, please always and often do this, I want to encourage you this time to ask yourself, who would benefit from this information? This really isn't mainstream information. It's really not something that's talked about. Most people do think that this is the Delaware versus the deferred trust, right? And so there's a lot of confusion around this as an option. And this is a powerful way to increase, the capital coming in our cash flow. So I want to encourage you, decide right now who would benefit from knowing this and just hit the share button. Until next time, cheers to health, mindset, and wealth.